Penny, nickel, dime, quarter, let's learn. Penny, nickel, dime, quarter, let's learn. Money, money, money in my pocket. Money.
Good afternoon, Kansas City. Welcome to the snowy and wonderful world of money right here on Moneyline. Now, by now, you know this is not Peter Newman's voice coming across your radio. My name is Mark Squires. I'm the Medicare Whisperer. I don't work for Medicare. I'm an insurance broker. When people have Medicare questions, my team and I have Medicare answers. Peter is off taking a well-deserved break today, but he asked me to tell you, his favorite listeners, that he will be back to talk with you very soon. Now, you know this doesn't happen without some magic, and back at the KMBZ studios is our producer. He is a fine young man who I am very proud to call my friend, the amazing Rocco. Now, he's going to make me sound even better than I look, and the bar is kind of low on that one, but he'll do a good job. You know, if you've never seen or operated a radio room control board, you know just how amazing people like Rocco really are. Thanks for being there, Rocco. I appreciate you very much. Well, look outside. It's a beautiful snowy afternoon in Kansas City, and our guest today is a frequent guest on the Moneyline program. I've had the pleasure of hosting the show with this man as a guest, and I've been a guest with him on the show as well. Mr. Scott Kaufmann with Kaufmann Financial will be with us shortly. Scott lives in the Kansas City area and has been helping his clients since 1983. He and I are the same age, and we're in a race to see which one of us retires last because we both love what we do. He has had 25 letters published in the Wall Street Journal. He's a graduate of the KU School of Business Administration and has also taught at the he has taught business statistics at KU. Scott is an avid and certified scuba diver. He enjoys listening to live music, serves his community through Rotary, and frequently volunteers to walk dogs for rescue shelters. With all of that, I also know that his heart is and always has been about putting the good of others before his own good. After we talk with Scott, I'm going to give you some updates on the topic of Medicare, and there is some very good news on that front. Now, go grab a pad of paper and something to write with because you are about to experience the best hour of the week in Kansas City radio right here on Moneyline. Mr. Scott Kaufmann, welcome to the program. How are you today?
Living the dream, Mark. Living the dream.
I'd be disappointed if you said anything else. Scott, tell our listeners how it is you came to be an advisor.
It's kind of a long story, but speaking of nickels and dimes, actually, I didn't have, when I was growing up, I didn't have a nickel for milk in elementary school, which kind of shows how old I am. It also shows, the biggest risk to investors' dollars, the simple fact that is Yogi Berra so wisely opined, a nickel ain't worth a dime anymore. And he saw that picking up the morning paper. It was a nickel, and then it was a dime. And today, my Wall Street Journal's newsstand price is $5. Talk about a nickel ain't worth a dime anymore. And then my dad became a financial advisor in 1974 when I was like 13, and I saw the dramatic improvement in our standard of living, and he just seemed to like what he was doing. He became friends with his clients, and so I decided a year after that's what I was going to do at the ripe old age of 14. And so, I went to KU Business School, and that's the only thing I've ever wanted to do. I've done it since I was 21, and like I said, we're kind of in a race. But that's pretty cool, if you can find something that, you really love, it's pretty fun. I also just have a lot of really nice clients, in a lot of them KCK. I've got some across the city and actually across the country. But, it's just really a lot of fun for me. Did I tell you that the quote in the first letter I had published in the Wall Street Journal was in response to an op-ed called The Happiness Myth. And, the idea that, some people think you can kind of have it all, and then you realize there are trade-offs. There are always trade-offs, and they were disappointed. And so I wrote in and I said, I think happiness is best expressed by a Zen quote, and it's the master in the art of living makes little distinction between his work and his play, his labor and his leisure, his mind and his body, his education, his recreation, his love and his religion. He hardly knows which is which. He simply pursues his vision of excellence in everything he does, leaving others to determine whether it's work or play. To him, he's always doing both, and I said, my wife's going to have this expressed around the walls of her entertainment room. It'll make me very happy. And Tim Lumber, the letters editor, I've actually had the pleasure of meeting with a couple times. He just retired after 33 years at the Wall Street Journal. Put the pursuit of happiness anonymous for him. So pretty cool.
There you go. There you go. I love that quote, and in fact, I'm going to have to go find it and put it in a frame and put it on the wall of my office. That's a beautiful thing.
I've got it 56 feet of that quote in 2.5 inch font all the way around my entertainment room. Yeah, pretty neat.
I'll bet that's a sight. I bet it really is.
Yeah.
So,
it's fun.
And we've only got, probably about we're coming up against a break, because I do have a couple other questions for you. But you said, how many times have you been published? I think you said
33
times?
now, actually. I just haven't updated it. Yeah. Yeah.
Okay, well, that's a feat. That's, I'm sure there's something that goes to that. Once you get published a couple of times, maybe they pay a little bit more attention. So, well, we're going to come back here and
kind of
make
random
things. But well, you sent the first submission, and that's what counts. So we're going to come back here in just a couple of minutes. And when you're in the field that Scott's in, you're constantly studying. And I'm going to ask him a little bit about economists and other authors that he follows or he likes to recommend to people. We are on Moneyline. We're up against a break. If you will stay with us, we will be right back.
Everybody can see. Take the money and run.
A little Phoebe Snow for you on a snowy afternoon. Welcome back, Kansas City. You are listening to Moneyline, and this is Mark Squires. I'm sitting in for Peter this afternoon while he takes a little bit of a break, and we are speaking with Scott Kaufmann of Kaufmann Financial. Scott, are you still with us?
Yep, I still am.
Good. In your line of work, study is something that goes along with every day of life. Are there any specific economists, both in the past or currently, that you like to follow, or authors that you follow or recommend to your clients?
Well, I mean, most of my clients don't really care about this so much. They rely upon geeks like yours truly, to follow that. So, but, my heroes, Milton, I have two heroes, Winston Churchill and also Milton Friedman. Milton Friedman was a Nobel Prize winning economist, and he wrote a book called Free to Choose. It's kind of the seminal work on, he was considered by many the most influential economist of the 20th century. And or 21st, 20th century, Free to Choose. There's also actually a really good book by Thomas Sowell called Basic Economics. Sowell's a really good. Those are probably my two favorites. I've read a bunch of books by. As a matter of fact, I've got a book called Knowledge and Decisions by Thomas Sowell. So they're both strong advocates of Milton sadly passed away, but free people, free markets. That's what I believe in, and actually Dostoevsky called money coined liberty, and it just gives you the freedom to live your own life, and I've seen both sides of it. I mean, I've owned the investments I've owned for the last 34 years. Have helped me become and remain wealthy predictably, and that's what I help individuals do. I help individuals become responsible stewards of the financial assets to which you've been temporarily entrusted. And I think you can get the financial, the physical, and the psychological / moral down. Life's pretty good. Number one business goal is to help people become and remain wealthy predictably. And I know of no better investment, and I'm living proof of it, to help individuals become and remain wealthy predictably than growth and income mutual funds, just dividend-paying common stocks, because companies that make money and pay dividends, you have to have cash to pay a dividend. And if you can not only pay that dividend and grow that dividend, you can do as well as growth companies, the sexy companies, with substantially less risk. Dividends provide a floor on the stock price, and so and part of that's actually been kind of lost, I think, especially with the FANGs, which still look great. FANGs being Facebook, Amazon, Apple, Netflix, and Google, along with Microsoft and perhaps Tesla. So those are all great companies, but only one of them, well, actually two of them, Apple and Microsoft, pay dividends. But they're still good companies to own. But I like the dividend paying common stocks in professionally managed portfolios.
Mm-hmm. It's a rhythm thing, isn't it? You just know it's going to work, and of course, as you know, it's if you can just depend on things, you can purchase more shares of mutual funds and slow growth with tortoise and the hare. You can either run around trying to find the next big thing, or you can just systematically invest and grow slowly.
Yeah, well, I don't think the whole idea of being defensive and protecting yourself on the downside and also seeing your money grow handsomely are absolutely mutually consistent objectives. And of course, this is no specific guarantee, or recommendation to anybody. Nor, obviously past results are no guarantee of the future. They're just our best indication. But if you look at Investment Company America, that fund has averaged 12% a year since the Great Depression, 72 up years, 16 down years. When I started recommending it in 1988, 10,000 had grown to the princely sum of $8 million. As of last year, $246 million. And it's never lost money in any decade in its history. And so it doesn't mean that it's risk-free. It just means that it follows Warren Buffett's 2 rules of investing, which is rule number 1, don't lose money. Rule number 2, if you have any questions, go back to rule number 1. Which is also, interestingly enough, about how so many advisors use all these fancy terms like alpha and all these crazy things that are meaningless to the vast majority of investors. When in reality, if you look at the dictionary's definition of risk, it's pretty simple. The probability of harm or loss, i.e., losing money. And so it doesn't mean these are risk-free, but God hasn't seen fit to ordain a risk-free investment for mankind. There is no such thing. And all you can do is manage as well as you can. But I'm telling you, again, the single biggest risk to your money, and this is being borne out this year, is inflation. I mean, if you had $100,000 in a CD paying you 0.5%, you think you earned $500. But in reality, you've lost $6,500 of purchasing power because prices have gone up 7% over the last year. You think you're being safe, but you're not. You're taking enormous risk with your money. It's about as close as death and taxes as something that's going to continue to happen. Obviously, once again, as Yogi Berra said, a nickel ain't worth a dime anymore. So unless your income and your money's growing, your money's not safe.
Completely agree with that. And that inflation has, of course, been all over the news. It's in the narrative today for the obvious reasons. You can't turn right or left without seeing prices go up. But quite often we hear some pundits say, well, inflation is a hidden tax on the middle class. What do they mean when they say that?
Well, it's not. It's not quite so hidden these days. I mean, I think.
Yeah.
I liken it to normally, even at 2% inflation, at prices double every 36 years. At 4%, which has roughly been the average over the last century or so, prices double in 18 years. But it tends to occur over such a longer period of time. This has been a different thing this past year, and Milton Friedman, my hero, said inflation is always and everywhere a monetary phenomenon, i.e. too much money chasing too few goods. We've increased the money supply 40% the last 2 years. That's why we're seeing inflation. It's cause and effect. But anyway, so normally, though, it occurs over longer periods of time. I use a lot of metaphors. One of the metaphors I use is that I liken it to soil erosion. If a farmer loses 15 tons of soil per acre per year, he's losing soil only with the dime. That's all 15 tons is. And then he loses that every single year. But if he continues to allow it to happen, his production's going down. And if he allows it to go on too long, at some point he's in the subsoil, and then his career as a farmer is over. So he has to do something about that erosion before it becomes readily apparent. If he waits until he already sees it, until he's kicking rocks, at that point it's usually too late. So that's why it's so important. It's being borne out this last year with prices soaring, but that's been going on. Prices have gone up all but 2 of the last 75 years. So it's not baked in the cake, but that's just one of the 2 things that governments do well: inflate the currency. So that's just the other ones wage war. Those are the only 2 things they do with great effectiveness. So
good observation there.
That was Peter Drucker actually in 1969. I had that in another letter I published. But on the 50th anniversary of Richard Nixon taking us off the gold standard. So yeah.
Well, we could do a whole show on that one, couldn't we?
Yeah. But
so where we're at right now, I mean, what is your take on the economy, domestic and globally?
The thing about it is the economy's going to be growing. I mean, it grew handsomely last year. Would have done even better had we not had so many constraints on the labor supply. We don't want to go down that political road, but that said, we're going to grow handsomely here, and also in Europe. Actually, looks like it's going to be growing solidly as well. And so there hasn't been a whole lot of growth actually in Europe, especially of earnings. And so I just always think it's smart to take a global approach. And, if you look at the average exposure to companies that happen to get their mail outside the U.S., right now, of all advisors, it's only about 7%. And that's just because our market's averaged about 16% a year the last decade. Companies that happen to get their mail outside the U.S. have done about half as well. But these, again, having taught statistics, the number one rule is everything regresses to the mean. So even though the long term still looks great for our market, but companies that happen to get their mail outside the U.S. will probably do better still. So it's just always important instead of trying to, and also from a big picture standpoint, instead of trying to predict the rain, build financial arcs. Build financial arcs of durable investments that have stood the test of time, globally diversify in high-quality investments, and then just be patient, as opposed to moving stuff around, which doesn't work. If you're moving your investments around, it's not going to work because money's like a bar of soap. The more often you touch it, smaller it gets. And so you just got to take a disciplined, consistent, long-term, low-cost approach. And if you can do that, everything works out great.
That's a great analogy, and now all of our listeners, when they take their next shower, are going to be thinking about money being like a bar of soap. Scott, we're up against a hard break at the bottom of the hour. Can you stay with us for another segment?
Absolutely. I'd love to.
All right, folks, when we get back, I want you to have something to ride on and write with because Scott's going to give his contact information, and you need it. We're here on Moneyline on KMBZ. We'll be right back.
Somehow you always know just what I need. So just do
Well, hello, Kansas City. Welcome back to today's edition of Moneyline. That's a song called Snow Globe. Looks like Rocco's giving us some good snow music today for bumper music. Hey, I'm Mark Squires, the Medicare Whisperer, sitting in for Peter as he takes a short break. And we are visiting with Scott Kaufmann of Kaufmann Financial, and he's kindly agreed to stay with us for another segment. Scott, our listeners have been hearing some great stuff from you. I love your analogies. How do our listeners get a hold of you if they want to talk more?
Well, you can email me at scott.kaufmann@lpl.com, and Kaufmann spelled Kauf as in Frank, MANN at LarryPeterLarry.com, or you can call me. My office is at 913-334-5100 or 913-334-5100. So, or actually, I also have a website. It's KaufmannFinancialKC.com. So all
Kaufmann again, so the listeners know how to spell Kaufmann.
Yeah, it's Kauf as in Frank, MANN. Unlike Ewing, who has 2 F's and 1 N, I have 1 F and 2 N's. So,
the man's got to differentiate himself.
If I could interject, I apologize for bringing this up, but sometimes I just think it's important because I was at my favorite watering hole last night. Shout out to Gil Hooley's great bar. And I was chatting with this guy who asked me, he's like, oh, didn't the market crash or anything? And so I just started asking him questions. And I don't expect you to know the answer to this, but maybe you do. I just thought it'd be helpful for our listeners to hear this, because I say, well, how often do you get a 5% decline in the market? And they said, how about a 10% decline? And then what about a bear market, a 20% decline? And you know, I mean, he's a real nice guy, he's smart enough, but he had no idea. So 5% declines occur on average 3 times a year. They last about a month. Okay? This is in the stock market. 10% declines occur about once a year, once every 11 months. It lasts about 3 months. So it don't last forever. Okay? And 20% bear markets occur about once on average, about once every 6 years, so they're rare still. Unfortunately, too many investors, though, are investing as if the '08 decline of 57% is going to occur again anytime soon. But we've only seen 4 declines of that magnitude since 1929. So those occur about once a quarter century, although we had 2 in 1 decade. So it's just important to understand that, to be prepared for that fluctuation, I think, and understand that's part of the process of becoming and remaining wealthy predictably. And so one of the things that, you know, if I'm in competition with somebody else, I'll say, well, how often do they tell you it's going to go down in value? I've never heard a positive response to that, because, you know, that's a negative. Okay. So part of the, you know, the quality of expectations determines the quality of action. It's important that clients know, and the only way you're going to be able to give them an idea on that is by using actual investments and showing them, you know, how often you can expect it, you know, to go down in value and by how much. And so obviously there are no guarantees with this, but I do think it's really important that people understand that this is part of the process, you know, and that even though, you know, these investments all have risk, because all investments have risk, I think you just want to own investments that you can still feel comfortable with the understanding that you can still enjoy terrific returns and have well-managed accounts as long as you manage risk well and own quality, diversify, be patient. All those things, and being patient is probably the most important of the 3. So,
I completely agree. And you know, in my 20 years in this business, I have found that most people think taxes will go up and the market will go down. And
well, actually, my American Funds guy, Jason Young, said if you could imagine, you know, the press tends to say that the market's either soaring or plummeting. But imagine if you got into an elevator and there were only 2 buttons. One was soar and the other was plunge. You're like, I think I'll take the stairs. And unfortunately, that's what ends up happening. You know, they end up in CDs earning nothing. And yet, you know, if you look at a good mixed fund, they're paying a 3% dividend right now, 3 times what you can get on a certificate of deposit, and it's earned 11% a year since '73. So, you know, you not only have better current income, but your income and your money can grow, and that's the key to success, having a growing income stream. Because again, if your income and your money's not growing, your money's not safe. It's got to grow.
There's always some form of risk, and the risk of losing purchasing power is equally as much risk as the risk of the market plummeting. Yeah. So,
well, but you know, markets. I mean, markets drop, and I'm not trying to make light of it because I know this is scary for people. That's why and you know, somebody wants to use my services, fine. But I also like trying to import some information, having been doing this, you know, for 4 decades almost. And just help people better understand, you know, how these things work. Because I do think it's important, or I wouldn't plan on doing it, you know, the rest of my life. So, yeah.
Well, that's
it's
good.
fun.
And hopefully for your client's sake and your family's sake, you live a long, long, long time.
Well, my dad's 90. Both parents are 96. So, and my mom still has the same shag carpeting she had in 1974. She rakes it every day. At some point, it's going to come back into favor. So, She'll be styling at some point. So
glad to know she's still raking it. That's probably why she's young at age in her 90s.
And by the way, they still own Investment Company of America at age 96. So
that's good. They have a great advisor. So what are you thinking on the Fed tapering? And I mean, you hear everything from a couple of interest rate hikes to, I heard the CEO of BlackRock the other day was talking about, there's going to be 4 interest rate hikes this year. What are you thinking about that?
I think, unfortunately, Fed Chairman Powell has just been wrong about this being transitory, and we'll see. They've accumulated a $7 trillion, $8 trillion bond portfolio, and they need, and so it's not like tapering means they're just buying fewer of them instead of actually doing something about this, as he's been just kind of dead wrong on inflation. And so we unfortunately have too many Keynesians in the Fed who just think we just need to stimulate demand. It's not going to have any impact. Well, it's having one. And so, but I do think in some ways as these supply chain disruptions work their way through the system, hopefully it won't be as bad, but certainly it's going to take a while to get this, 40% increase in the money supply to work through the system. I mean, it's just, and so, but as always, and if anything, that's probably another reason maybe to globally diversify. But ultimately, I just think it's really important to stay disciplined and consistent in this. We may see higher inflation than people continue to see. If you look at, again, with the money supply, and so maybe 3 is not going to be enough, could be 4. I think they really need to pull back on the credit strings. This has been really a 13-year experience since 2008. Yes. I mean, they've been printing a lot of money, and now it's kind of coming home to roost. But long term still looks great. Actually, if anything, this mRNA technology, the Capital Group thinks in a decade, cancer will no longer be a death sentence. Martin Roma actually likened this to 1942. In April of 42, we were so ill prepared for war that the cavalry at Fort Riley was still teaching equitation, and 75% of our cannons were horse-drawn, built in France in the 19th century. And yet 3 years later, we're in the atomic age. So some things are going on right now. It took over a century to come up with a typhoid vaccine, and yet in 42 days after sequencing the virus from Wuhan, a Turkish couple working in Germany, German citizens, under the auspices of a U.S. domiciled company, pharmaceutical company, under the guidance of a Swiss pharmaceutical person, and using Israeli software, came up with it in 42 days. 42 days. Nothing short of amazing. And the capital analysts, even 3 months before it came out, they said if we can get 65% efficacy, it's a game changer. It was 95%. And so just amazing what private businesses have been doing, and that just also shows just the amazing things that are going on out there. And you just need to get a piece of it. Because, that's the other thing about it. I just got a client stroke me a big check the other day, and I just told him, I said, should we wait? And I'm like, no, we need to get it invested because there's no way you can earn these returns unless you own it. If you're trying to time the market, it just doesn't work. It never works. Okay? You just got to own it, but own world-class, time-tested investments in the right amounts for long pull. Hopefully stuff that's had a good history of protecting you on the downside, but still giving you a good rate of return and giving you that growing income stream, which is essential.
Scott, thank you so much for being with us today. One more time, what's that phone number?
913-334-5100. Again, you can email me at scott.kaufmann, Kaufmann, @lpl.com, or my website is at kaufmannfinancialkc.com. So you can reach me any of those ways. And, thank you so much, Mark. I really appreciate it. It's been, it's always fun for me to do this, and and we'll also, shout out to Peter if he's listening, and hopefully, he's doing okay. So.
Yeah.
Okay.
Well, I appreciate that, and I'm sure Peter is listening. And Scott, thank you so much. I've had fun. I appreciate that you've had fun. I know our listeners have enjoyed it. We'll talk to you again soon. We're up against a break, and we'll be right back on Moneyline.
We got to install microwave ovens, custom kitchen deliveries. We got to move these refrigerators. We got to move these color TVs.
Well, welcome back, Kansas City. So glad you stayed with us. We just got done with 3 segments with Scott Kaufmann of Kaufmann Financial. I do hope you enjoyed that. And we're going to wrap the show up. I cannot believe how fast this hour goes every time Peter lets me host this. It just flies by. Well, listen, I want to talk a little bit about Medicare. That's what I do all the time is Medicare. So there's been some odd news out this week that I think there was a report that CNBC put out on I think it was on the 10th of January, that Medicare may scale back that Part B premium increase. And, of course, everybody who heard that was jumping up and down, yay, yay, yay. As of now, there's been no official release on that one. But one of the reasons that they hiked it up so high was that there's a new drug coming out, or it actually is on the market now, called Aduhelm, which is an Alzheimer's treatment. And believe it or not, the per-patient annual cost on that drug was $56,000. And of course, I'm not privy to all the back office conversations, but my guess is that the fine folks at Medicare leaned a little bit on the manufacturer and said, yeah, some things aren't going to fly. And so there is a report that they have lowered that cost to about $28,000 per patient per year, which, listen, if it can treat Alzheimer's and give Alzheimer's and dementia patients a better quality of life, why not? That's what we need. It's a horrible disease, and if you've ever known anybody who's dealt with that, you know what I'm talking about. So it could very well happen. They haven't announced it yet. Let's hope that they do, because we did experience the largest premium increase in Medicare Part B history. So we'll just leave that there. Now, how many of you are excited when you turn on the television and here comes the commercial, whether it's Joe Namath or J.J. Walker or whoever the Olympic athlete was from the 1970s, or Martha? How many of you get so excited when those come on? And you notice right toward the end of the annual election period, right around December 7th, for about a week, it was nonstop. It was nonstop. Commercial after commercial after commercial after commercial after commercial. Well, here's an interesting thing that happened. In the middle part of the annual election period, about 2 million of you called Medicare and complained. And they said, this is confusing. We don't understand it. Because they were saying, well, if you live in the right zip code, Peter told me he was going to move to a better zip code just so he could get money back on his Social Security. Look, those commercials are tricky. And the truth is there are some plans in the country that will give all or part of your Medicare Part B premium back in the form of a credit to your Social Security check. And that's nice. In Kansas City, we have 3 of them. I think 2 of them give you $50 back, and one of them gives you $60 back. And that's great, except for they don't have drug coverage. And Medicare says you need drug coverage. So you need some other kind of creditable drug coverage. I do know there's one zip code or one county in Florida where you can get 100% of your Part B premium back. So let's all move to Florida. They need more residents there. And plus, hey, no state income taxes. So let's all go. I'll have the moving truck ready right after the show. So anyway, there is some new, it's not legislation yet, but Medicare, CMS, is in the process of studying these TV commercials. And as you know, the government will typically use the broadest possible paintbrush. So what they're doing now is they're trying to define what they call a third-party marketing organization. And right now they say anybody who sells Medicare plans is a third-party marketing organization, which is not true. In this case, they're taking comments from people who are on Medicare like you and people who are in this business like me and a lot of my associates here in Kansas City. So taking comments on that to find out exactly what's going on out here. So, I mean, I'm not going to turn Peter's show into a telethon, and I'm not going to give a phone number out here. You know how to get a hold of Medicare. It's 1-800-Medicare. They're open 24/7. You can call them anytime except on major holidays. They won't be open Monday because it's a holiday. But, if you want to call them and say, hey, I'm tired of these commercials and I would like for you to do something to, look, I don't want the government restricting private business, but at some point it gets abusive. And if you call Medicare, the best time to call them today would be right after Moneyline is over. But reach out to them and tell them what your thoughts are. It's also not a bad idea to shoot an email to your congressional representative or your senator. They have some sway in that. But here's the thing: if enough people on Medicare are letting the folks at Medicare know that, because let me tell you, I'm in this business. We are highly, highly, highly regulated in what we can say and what we can do in the process of marketing to people. My team here, we take a little bit higher approach. We're very, very local, and we want to take the highest possible standard so that we're not telling people, if you live in the right zip code, blah, blah, blah. But when they do those TV commercials, they're trying to cover a message for everybody on Medicare in the country. That's why they're so confusing. And so, again, just maybe letting somebody know that's in authority that you're a little tired of those commercials might be a really, really good idea. So, think about that. Other great things that are happening in Medicare, we have this thing, and from a marketing standpoint, we're not allowed to discuss this, but I'm giving you commentary. I'm not marketing to you. Everybody knows that you have the annual election period, which is mistakenly called open enrollment, and that's October 15th to December 7th. But what a lot of people don't realize is you have a second chance, and that is the period from January 1st to March 31st is the real Medicare open enrollment period. And what that period is a time when if you chose a Medicare Advantage plan during the annual election period and you're a little jittery about it or you're not quite happy with it, you can either go back to original Medicare or make one change. Now, you can't change. But you can make a change or go back to original Medicare, and you may want to consider talk with your broker, your local broker, about whether or not you qualify for a Medicare supplement at that time. But what you can't do is if you have a prescription drug plan, just a standalone prescription drug plan, you cannot change that during this time. But if you're on Medicare Advantage, you can make one change. Okay? So one other thing I want to address, because I'm just getting really close to out of time. If you or you have a loved one who is on Medicare and happen to be in skilled nursing, maybe you had a negative event, maybe a heart attack or something, and you had to your loved one or you had to go to a skilled nursing facility for a few days. You have an opportunity from 60 days from the time you've been in skilled nursing while you're in skilled to 60 days after you get out to make a change in a Medicare Advantage plan. And a lot of times in skilled, you find out if your Medicare Advantage plan is a weak one or a strong one. There is no such thing as one size fits all. So certainly I encourage you, if you're in that situation, have one of your family members reach out to your broker or to a good local broker like us at the Medicare Whisperer and see if you do have any opportunities there. Same rule applies if you are in a nursing home. Now, you've heard me say this before. The most misunderstood part of all of Medicare is that Medicare does not pay for custodial nursing home care. They will pay for your medical care while you're in a nursing home, but they will not pay for that room and board. So don't get hung up in that. Don't make that mistake. But if you're in a nursing home and you're on a Medicare Advantage plan and your family or your doctor or the providers tell you, it might be a good idea if you don't stay on this Medicare Advantage plan, you have an opportunity to switch. So, again, you don't have to memorize all of this stuff. That's what people in my line of work do. We know what we're doing. We eat, breathe, and sleep Medicare, if you can imagine that. So, again, I always encourage you, ignore the toll-free numbers on the television and the radio. Those are not your friends. They're not your neighbors. You're probably not going to see them at the grocery store. You're probably not going to see them at the football game, whether it's high school or college or the Chiefs. Go Chiefs. Work with the local broker, and there's a lot of us in Kansas City, and most of us are very, very good people who are very, very community-minded. Look, my clients are my neighbors. They become my friends. The whole team here at our office are that way. you want to work with somebody local. Same thing with your CPA. If you're going to work with a CPA, you want it to be local. You don't want to work with a CPA in Washington, D.C. Well, you don't want to work with anybody in Washington, D.C. probably. Local is the way to go. Somebody that you can reach out to, that you can talk to, that, again, you're going to run into in the community, because we have a vested interest in making sure you're well cared for. That's what we want to do. Look, a lot of changes are coming to Medicare, and my team here at the Medicare Whisperer keeps on top of those. You can find us online at lifewithmedicare.com. You can call us at 816-841-9141. You can even chat with us online. We're all over social media, so look us up. If you got a question, we've done this. We started my 20th year in business a couple of weeks ago, about a month ago. I've always done this. If you have a question, whether it's financial or Medicare related, give us a call. We'll give you a 15-minute phone visit, and we're not going to charge you for that. In fact, the government says I can't charge you for Medicare phone visits or anything else Medicare related. We just want to take care of you and be your friends. Hey, thanks for listening to Moneyline. I am always thankful that Peter allows me to do this show and trusts me with his show on the air for nearly 40 years. We're looking forward to the next 40, Peter, if you're listening. My name is Mark Squires. I've had this honor, and I do not take this honor lightly. Thanks so much. We'll see you next week on Moneyline. Don't you dare miss it.